Hi everyone, this is Professor Watts coming at you one last time for a homework tutorial for Econ 221 for homework 5/6, which we're going to be focusing on doing some taxes. So let me open up my Excel file here, and you'll be getting an Excel file that looks almost exactly like this. With I think I have 6 scenarios in the homework file, and you'll go through each one, read the scenario over here, and then we're going to fill in the appropriate boxes for the person's filing status, information about deductions and credits and whatnot, and then we're going to just plug in the income here and let the calculator do its work. Now, let me remind you that the tax brackets work in the following way. So currently under the Tax Cuts and Jobs Act of 2017, we have these 7 brackets ranging from 10 to 37%. Remember, we're talking about a progressive system, so the higher your income goes, and you can see here in the bracket, we're looking at income for either unmarried or married or heads of household. Okay, as your income goes up, you start to climb into those higher and higher tax brackets. And remember, they're marginal tax rates. So we're talking about extra income you earn if you're unmarried single over 9,500 is taxed at 12%, right? And then extra income you earn above 38,700 is taxed at 22%, and then the extra income above 82,500 is taxed at 24%, etc., until we get to that top level of 500,000. So anything you earn over 500,000 is going to be taxed at 37%. Okay, so we'll do some examples here, some sample scenarios where we'll see how that progressivity plays out. And people who earn extremely high incomes are going to be paying a overall tax rate pretty close to 37% because the bulk of their earnings is going to be above 500,000, right? Okay. We also have a whole lot of deductions in the tax system to think about, but we're only really going to look at one here. Actually, we'll look at two. We'll look at the standard deduction that everybody gets, and that varies depending on your filing status. So singles get a standard deduction of 12,000. Married filing jointly gets a standard deduction of 24,000, and the head of household, which would be a single person living on his or her own, gets a standard deduction of 18,000. Now, what is a deduction? Remember, a deduction is a decrease in your taxable income, right? So we'll take off the deductions and then we'll arrive at the taxable income, and then we'll apply the tax brackets here to the taxable income. I have a calculator set up here in Excel that's going to first off find the applicable tax rate using some if functions, and then using some if functions and the tax brackets, we're going to apply the appropriate rate to each chunk of income. So if you have more than 9525, if you have less than 9525 in income, we're only going to apply the 10% tax rate to all of your taxable income. If you have more than 9525, the way this works is this if function is going to see if your income puts you in this tax bracket, and if it does, I've got some other if functions in here that are going to just kind of scan through the brackets and then apply the appropriate rate. Okay, so this is all set up. I've tested it and checked it. I think it's pretty close to accurate, and it's going to give us a pretty good idea of how this income tax system actually applies. All right, so let's look at our sample scenarios here. So starting off here, we've got Joe Sixpack lives with his parents, so his filing status is single. So the very first thing we're going to do is plug that in here, and that's going to automatically populate the standard deduction, the appropriate standard deduction over here. Okay, and it says he earns 15,000 a year at his fast food job, so that will take that as his gross income, 15,000. Okay, he does not have any spouse or children and does not make contributions to a tax qualified plan. So no qualifying children, so we can plug a 0 in there. No IRA contribution, so we can plug a 0 in there. Qualifying children, of course, you'll recall from my lectures, will give you a refundable tax credit. It's actually one of the most generous credits in the whole tax system. And then making contributions to an IRA, an individual retirement account. That's one of several what they call tax qualified plans that you can have, and that is a deduction that subtracts that amount of income from your taxable income. But Joe Sixpack doesn't have any of that, so his taxes are going to be pretty simple. Okay, so he's got 15,000 in gross income. So we subtract this 12,000 standard deduction, which Excel is going to do for you. He winds up with $3,000 in taxable income. Okay, so what tax bracket is he in? Well, his income doesn't go over the 95-25 threshold, so he's going to be fully within the 10% bracket. So his tax is going to be very simple, just 10% of the $3,000 taxable, which is $300. And so there's his total tax before credits. He has no credits, no earned income tax credit or anything else. So his net tax is going to be what is reported in G20. And that automatically calculates. You don't have to do anything there. But one thing I am going to have you do on all of the scenarios is calculate the average tax rate, which is tax due as a percentage of gross income. And the way we do that is very simple. We just go into this average tax rate box and do a simple formula, equals the net tax due divided by the gross income up here in G2. Right? So that formula will be the same for every scenario. So Joe's six-packs, his tax rate his average tax rate, his overall tax rate is only 2%. Right? That's progressivity for you, right? The bracket's 10%, but remember, most of his income is sheltered from tax through the standard deduction. And that's exactly what standard deductions are meant to do. They're meant to not have that income tax hit you until you make above a certain amount of money. Okay, so there's sample 1 with Joe's six-pack. Let's move on to sample 2. I've got a family situation this time, and a little bit more complicated tax setup. So we've got Kip and LaFonda Dynamite, are a married couple making $45,000 per year and raising 3 beautiful little tax credits, children at home. This year they managed to save a total of $2,000 in their tax-qualified IRA. Okay, so let's start with their gross income, $45,000. And then we have to select filing status. They're a married couple, so they're most likely going to be married filing jointly. They, let's see, they have 3 beautiful little tax credits, so that's going to be 3 qualifying children will enter here. And then finally, they're going to save $2,000 into their IRA. Okay, so notice now, the married filing jointly deduction, $24,000 is going to populate over here. The retirement contribution is also a deduction. That's going to reduce their taxable income. So they're going to be able to reduce their taxable part of their gross income by, it looks like, more than half here. Taxable income is going to be only $19,000. Now, because that's above the threshold level for the 12% bracket, but not above the threshold for the 22%, they're going to be in the 12% bracket. Okay, so they're going to pay the 10% on all the income under 95.25, which is right here. 10% of that is $952.50, of course. And then 12%, they're going to pay on their income between 19,000 and the 95.25. So they have 94.75 worth of income in this 12% bracket, and if we multiply that by 12%, we'll see that that tax portion adds up to 1137. So then the total tax is then the sum of those, which is going to be $2,089.50. Now, however, they have the child tax credit, all right? And the child tax credit says that they've effectively paid $6,000 in tax already. So their net tax due is actually $3910.50 negative, right? They don't owe the government anything. The government's going to pay them because the child credit is refundable. Now, technically speaking, only a portion of the child tax credit is refundable, and I don't have this set up with that level of detail, but we'll just go ahead and accept the fact that they're going to get a hefty refund to the tune of $3910. In reality, it'll be a little bit less than that. All right, so what's their average tax rate? It's going to be a negative tax rate, right? This is how credits and refunds work. Negative 8.7%, right? So there are strong subsidies in the tax system for having children, making contributions to the IRA, and then a whole host of other deductions and credits that we haven't even really gotten into. I'm just showing you a few of the big ones. We're trying to keep the calculations pretty simple here. All right, so that's an example that it has several deductions credits scenario. Now let's look at one more example here just for the homework tutorial, and then I'll turn you loose on the homework. You're going to do the exact same type of thing. I think you'll find it pretty straightforward. And now we'll look at somebody with extremely high income, and we'll see how that progressivity really kicks in. So I just looked up for Steph Curry. I found his salary here. According to Google, it's 37 plus million, so I'll go with that. Well earned. He's only won 3 championships, right? So very well earned for him. Earning $37 million for the 2018 season. He and his wife Aisha have 3 tax credit qualifying children. Okay, ignoring all the possible deductions. I'm sure he's probably got some financial planners helping him out with some deductions, but let's just ignore that for now. What will Curry's income tax be under the current rate structure? Okay, so his income is 37, 1, 2, 3, 4, 5, 6, 37 million, and married with children, so probably going to be filing jointly. Number of qualifying children again is 3. Probably making an IRA contribution, but let's just put 0 to keep things simple. Okay, so we are going to apply 10% tax bracket to all income in that bracket, right? He's going to be, of course, in the 37% bracket. So he's going to pay the full 10% tax, the full 12%, the full 22, the full 24, the full 32, the full 35, and then the 37 on all of his income over 500,000. So if you're making 37 million minus 500,000, he's going to be paying the 37% on 36.5 million. So let's multiply that by 0.37. We see that he's going to be paying 13,505. And I got a little discrepancy here. Oh, it's because I didn't take out the standard deduction. Yeah, so we take out the standard deduction. So it was pretty close. So he's going to be paying 13.6 million in tax, assuming he doesn't have other deductions. And like I said, it's very likely that he has other deductions and credits, but they're not going to take this total tax down that much, right? This is how our system is designed to work. Extremely high income people pay an extremely disproportionate share of the total income taxes. So his average tax rate then is going to be his net tax due of 13.6 mil divided by his total gross income of 37. And look, that's going to be pretty close to 37, right? Because he is getting hit with the 37% tax rate on pretty much all of his income, right? Because his income is so high. So his average tax rate, the average tax rates kind of converge up to your top marginal rate as your income grows. And that's kind of one of the things I wanted to see with this kind of example. Okay, so that is income tax. Pretty basic, pretty simple, but now you've got an idea of how it works with the brackets, with the deductions and credits, and you'll be in pretty good shape, I hope, going forward, understanding the tax system and doing your own taxes in the future as you earn a lot of money as a student who has taken your macro econ. Good on you.